This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Bashardis. Thanks for joining us at XM.com. Global markets are set to close the second quarter on a cheerful note, with risk assets flying high and safe haven instruments losing their shine as a stream of encouraging data releases increasingly convinced investors to unwind bearish bets. Recession concerns have been put on ice, especially in the U.S., after the final reading of GDP for the first quarter was revised higher yesterday. Coupled with a decline in weekly jobless claims that helped dispel fears the labor market is loosening, traders boosted their wagers on the Fed raising rates next month, with the implied probability of a rate hike in July now standing around 85%. As for the dollar, signs that the U.S. economy is more resilient than other regions and the resulting rally in U.S. yields were mostly offset by the hawkish rhetoric from central banks in Europe and weaker safe haven demand for the dollar, leaving the reserve currency only a shade stronger this quarter. Japanese authorities escalated their warnings about FX intervention earlier today, with Finance Minister Suzuki characterizing the latest moves as rapid and one-sided as the yen fell to touch the 145 mark against the US dollar, the region that first triggered intervention last year. Judging by the sharp spike in implied volatility for dollar-yen options this week, investment managers have started to hedge against sharp moves in the yen over the summer, either through FX intervention or via a Bank of Japan policy shift. Yet this reassessment is only visible in derivatives markets, as neither Japanese bonds nor the yen have moved much. The next piece of the puzzle for the yen will be the Bank of Japan's Tenkan Business Survey on Monday. Stock markets have steamrolled their way to victory this quarter, with the S&P 500 rising 7% and the Nasdaq gaining more than 11%. It's been a case of all news is good news, as equities have advanced despite a powerful rally in global yields. On the contrary, it's been a painful quarter for gold prices. With equity markets going into overdrive and recession nerves calming, demand for safe haven assets suffered a major blow, and the sharp rally in real yields didn't do gold any favors either. Finally, there's a barrage of key data releases on tap today, with Eurozone CPIs and the U.S. core PCE stealing the spotlight. This was today's Daily Market Comment. Thanks for joining us at XM.com.